Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark tells us the shine is off the darlings of the North American equity markets. Japan-based Corbett report publisher James Corbett gives us the lowdown on what's happening in Asia, including the meltdown of the Shanghai exchange. We'll talk to Ross Clark right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. Welcome back to This Week in Money.
Nice to be with you, Jim.
The stock markets in New York are not doing well. Even Apple has had a bite taken out of it.
Apple new highs not that long ago, and here we are now under the longer-term moving averages, trading down, I think, 115 as of this week. So the leaders on the upside have started to give up ground. And, you know, we talked about the last couple of weeks here. We had really four sectors that were holding things together: the biotechs, the pharmacares, the healthcare, and U.S. financials. And each one of those in the last couple of weeks has pulled back to test of support level, bounced, but not well. And now they're starting to put in lower lows. So the leadership that you're always looking for, what's going to carry this market, we would be looking for some sector rotation. What's next and coming into the fore. And at this point, there's really nothing on the equity side when you take a look around. It's been over in the bond market where the flight to quality, I would say, and the credit spreads are really starting to show themselves. The early part of July, end of June, we talked about the U.S. Treasury, the TLT, as looking pretty good. It had sold off hard the first 6 months of this year, and we were coming into what is the favorable time of the year for the Treasury bonds as they move through the summer into September. And that's the way things are unfolding right now. We've got treasuries sitting at their best levels since back in early May, and on the other side of the coin, the high yield items are now testing the lows of the year and looking like they're fairly vulnerable. The middle of the pack, the corporates are holding in reasonably well, but clearly, it's been a shift as we've seen with the poor participation in the equity markets, the advanced decline line, new highs, new low ratios, all just slowly giving up ground the last couple of months, and we've now got most of the averages, the Dow, the Russell 2000, the S&P. All now at or below their 200-day moving averages. So the momentum has been lost to the upside.
Is it true that most equities have lost all the value they gained since the new year?
Yes, I would say, and better than half of them have, and in particular, the indices look better because some of the big name stocks, the high capitalization ones, the Googles, the Amazons, the Facebooks, that did make new highs, made them in a dramatic way, not marginally. They were up considerably through their old highs. And so when you then put together an average, rather than the mean, those high flyers and high percentage moves outweigh what's happening for the bulk of the market. So, for anyone who was in energy or resource based items, clearly it's been a poor year. But also for the general market, it's been a flat to down year at this point. And
people get excited when they see all these new highs that were being generated just a short time ago, Isn't that really a time to get out of the market?
Well, I mean, typically you've got we're into that poor 6-month stretch here from the early part of May through the end of October. It's usually that you see lack of upside action more so than a lot of downside. But you do have this period where you would look for better shakeouts than you would normally see in the positive 6 months of the year. And I've been looking at the percentage moves off the high with the indices should find support in that 4.5% to 6% level. We've been there. Looks as though we're going to give up that ground right now. The next key level being at a 10% move off the high. And that becomes a major support area as far as the markets are concerned. As we move through into September, I think that's what people need to keep an eye on.
What's happening with gold bullion?
Well, the last couple of months here, gold got hit really hard as it moved through the 1140. We had that big seller in China on a Sunday evening, cracked the market. And since then, we had a pretty good clean out in the positions of the futures contracts, which we can see from the commitment of traders data that's provided. And for me, it's not so much the outright level of the data as it is the rate of change. How quickly are people putting new positions on or taking the positions off? And the COT numbers the last couple of weeks here have broken fast enough in terms of the speculative positions and increased for the commercials to reduce their short positions. Those changes have been enough that they are classic that we see around within 2 to 3 weeks of a bottom, or an interim low, I would say. So we're now far enough along in that 2 to 3 week window that one should be looking for a pretty good bounce. Historically, the 50-week moving average, 200-day, would be a reasonable target. So for bullion, which sits just under $1,100 right now, I would say that a rally into the 1140 to 1170 range would appear reasonable. Typically from an oversold like this, it would take anywhere from 6 to 12 weeks to make that type of recovery. Not a major move, but enough to provide some potential, and in particular for the miners, which have just been devastated here in the last few months.
Ross, thanks a lot for chatting with us.
Nice to be with you, Jim. My
guest has been Ross Clark, Investment Advisor at CIBC Wood Gundy, Vancouver. If you'd like to send Ross a message or get some advice, his email is ross.clark@cibc.ca. Coming up, James Corbett on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with James Corbett, publisher of the Corbett Report. James, where are you based?
I am based in western Japan, about halfway between Osaka and Hiroshima.
And the last time we talked, I think we described it as the Penticton of Japan.
Something like that. It's pretty similar. And it is absolutely scorching hot here, so maybe that parallel works as well.
But it's been scorching hot here as well. Temperatures into the 30s, sometimes the 40s. We've had a 4-month drought in Vancouver, so very unusual for us. James, the big thing that's happening in Asia, of course, everybody has their eyes on the Shanghai Stock Exchange and the meltdown that's happened there. Maybe describe the feeling and how people are looking at it.
Well, obviously there has been a bit of panic, but I think that panic has been largely allayed by the fact that the Chinese government stepped in and did pretty much precisely what everyone thought they were going to do, which is backstop the markets any way they can, through any means they can, throwing everything, including the kitchen sink, at the problem. And I think over the past year or two, the Chinese government has been sending a lot of signals that this is exactly what they would be doing, that basically they would be backstopping and guaranteeing the markets. And that's certainly what they're attempting to do. And although they have had mixed success with that, at any rate, they've averted the complete meltdown of the stock market that seemed to be taking place in the early part of July. So they have committed an incredible amount of resources to this problem, and I think investors are looking at that and seeing that, and now realizing that the only thing that the stock market is really good at is basically the guaranteed investment, as it were, from the Chinese government, that they're not going to let it fall all of the way down. But on the flip side of that, the regulations and things they've been putting in has shown that they will also even go so far as to prosecute, or at least threaten to prosecute, short sellers and people who are seen to be trying to quote unquote manipulate the markets by selling off their stocks. So I think investors have to take that into account as well, which again just shows that the Chinese stock market is a bit of a joke, really, when it comes to world stock markets. And I think this is basically just proving the lie that this actually represents anything underlying the Chinese economy.
Yes, there's always danger when you get into investments in China. I remember covering a trial that lasted for 10 years here, a man trying to fight extradition on corruption charges in China. And I said, did you really do it? And he said, my only mistake is I bribed the wrong people.
It's, yeah, well, that doesn't surprise me in the least, especially because the Xi Jinping administration is trying to, it has a lot of lip service about cracking down on corruption, and certainly has done so in certain instances, but the implication is that they will obviously never really crack down on Xi Jinping's circle or people who are closely related to it, more to do with his political rivals or people of no political consequence. So if you're in the right circles and moving with the right crowd, I'm sure you will be safe from such prosecution. But if you're in the wrong circles, well, you could end up in a kangaroo court, essentially. And unfortunately, we know how that tends to work in communist dictatorships like China.
Yes, their excuse for the way the courts work is, well, the police would never arrest innocent people.
Yes, a similar mindset exists in Japan, which I think has something like a 98 or 99% conviction rate, which is just mind-boggling to think. If you get arrested in Japan, you are almost certainly getting convicted. So yes, I think there's some interesting quirks of the Eastern Asian mindset when it comes to justice, generally speaking.
How's the Tokyo Exchange holding up with all this action happening not too far away in Shanghai?
It has shown a bit of volatility, and in fact, the last time I checked, it was actually tracking upwards slightly, but I think that's to do with more to do with the JPY USD link and what's going on in those markets. But certainly the Nikkei has shown some volatility as a result of what's going on in China, because obviously the Japanese and Chinese markets are increasingly related. So I think we can see the sort of, they used to say that when America catches a cold, or when America sneezes, the world catches a cold. I think that's becoming increasingly true of China, which obviously has knock-on effects throughout the global economy, including with some of its larger trading partners here in East Asia.
Is anything happening with those large cities the Chinese built with nobody in them?
Not enough, certainly. I think what we've seen over the past 6 or 7 years is the fact that the lion's share of the growth in the Chinese economy has been on the back of infrastructure projects funded by credit, easy credit being provided by the People's Bank of China. And that has created the problem, which essentially has led to this stock market problem. I think the stock market problem is only one indicator of the deeper underlying problem of the Chinese economy, which is that there has been all of this easy credit sloshing around the system for a number of years now, and that has been soaked up in a couple of different ways, one of which was we started to see the formation of what's looking like a real estate bubble in China. And the all-wise, all-knowing central planners of the Chinese Communist Party decided that in order to avert the real estate bubble crisis, they were going to encourage investors to spend that money in the stock market instead. So that's the PR campaign we've seen over the past year or two, with the Chinese government basically urging people to get involved in the stock market, which they have increasingly done. And of course, we see where that has ultimately led to. Really, the easy, funny money from heaven that the Bank of China has been providing in the economy for the last several years has led to an incredibly large and incredibly precarious shadow banking system in China, where you have these exotic instruments, these wealth management products and umbrella trusts, and all of these various ways that people can essentially borrow money to gamble in the stock market. It's never been easier to do so, and that's exactly what's happened. So I think that these giant mega cities that they're building, these big empty cities and things of this, are just another expression of that same problem. All of this credit that's looking for a place to be soaked up. So they are doing these massive infrastructure projects without really people to populate them or economic activity to underlie them. And you can play that game for so long, but I think what the Chinese government is finding out is that you can't play that game forever.
Have they outright banned short selling in Shanghai?
They have not outright banned it, but they, for example, just the other day, I believe after the close of trading on Monday, they instituted some new laws on short selling so that basically short sellers now have to wait 1 day in order to repay loans on borrowed shares, which they say is going to make people think twice about betting on markets failing. So, for example, we had the largest broker in China, CITIC Securities, halted short selling earlier this week in order to adjust their programs to fall in line with these regulations. So we haven't seen an outright ban of short selling yet, but we've seen the threat of prosecution for people who are found to be trying to manipulate the markets by engaging too much in short selling, whatever that means. And we've also seen this jiggering of regulations that have, at least some of the larger brokers have had to basically halt their trading to take account of. So certainly there is a crackdown on short selling that's going on right now.
Have fears about a possible slowdown or crash in China, have they powered all this money coming from China that's snapping up real estate in places like Vancouver?
Yes. I mean, I think, again, that's just another expression of the same problem. We've definitely seen a lot of people with capital in China looking for ways to get that capital out of the country and investing in foreign real estate, including, especially, of course, in the west coast of Canada, has been one of those outlets for capital outflows of China. And in fact, we've started to see larger and larger capital outflows from China. In fact, what's reaching something of a worrying peak or a worrying trend, to the extent that now the Chinese government is trying to backstop the yuan by spending off their reserves. And we've just seen, I don't have the numbers in front of me, but there has been some startling outflows of reserves in the last couple of months as Beijing is basically trying to stave off all of these or balance all of these capital outflows. So we have, for example, we saw that or last year there was a story about Euroclear and Belgium with all of its sudden boost in U.S. Treasuries going from $170 billion to $381 billion in a matter of months. And that was ultimately found to have been the PBOC, the People's Bank of China, basically using the Euroclear, aka Belgium, as a clearinghouse to purchase U.S. Treasuries on the side. But what we've seen in the last few months is basically the unwinding of that. China has dumped $143 billion worth of those treasuries, not their official holding of $1.3 trillion, but their sort of side holding of U.S. treasuries. They've dumped $143 billion worth in the last few months trying to fight off these capital outflows from China. So this is becoming a growing problem. And in fact, in Q1 of this year, there have been $300 billion of capital outflows from China, a staggering figure. So definitely people are trying to look for ways to get their money out of the Chinese economy right now, because I think the writing is on the wall. We've definitely seen the slowdown in manufacturing and the productive side of the Chinese economy and the growth of all of these bubbles and all of the volatility that comes with it. So you can certainly understand why people with any amount of capital in China would be trying to get it offshore.
So the crash of the Shanghai exchange basically is the canary in the coal mine for the Chinese economy, isn't it?
In an indirect sense, yes. Not in the direct sense, because it should be kept in mind that in China, unlike in New York or London or Tokyo or the more developed Western markets, there is only about 5% of private sector fundraising coming from the stock market. So the volatility in the stock market doesn't really affect very much the underlying businesses themselves, the ones that are floating on the exchange, but it does show that, again, what I say is the sort of underlying problem here, which is the question of all of this credit sloshing around in the economy that the PBOC recognizes as a problem, and they've tried to basically stop the spigot a few times in the last few years, but every time they try to do so, there are huge consequences to that, including cash crunches and things of that nature. So they're in a very precarious situation, and like a lot of these other countries, have basically painted themselves into a corner with all of this funny money sloshing around in the economy, which probably should sound familiar to people looking, for example, at the Fed and what they're going to be doing later this year in attempting to raise rates, which just defies all economic sense. But again, they've painted themselves into a corner.
Well, it looks like the Fed so often has no idea what reality is by their actions.
I think I would say they like to pretend that they can control it, but reality has a way of asserting itself.
Speaking of coal and canaries, is China doing a good job of weaning itself off coal? They talked about that, but is it real?
I'm not so familiar with the Chinese situation, but I know that the U.S. Coal market is in some pretty grave difficulties, and it's actually unprecedented in a lot of ways, because we've certainly seen down periods and down times with coal before, but it's always bounced back. I'm not so sure that it will be able to this time. And that's for a number of different reasons. Not only the sort of new energy possibilities that are coming online, but even just the competition from old energy competitors that's being enabled by falling prices and energy technology disruption. So, for example, natural gas in the U.S. market has dropped from 1079 per thousand cubic feet in 2008 to 194 in 2012. That's essentially a 90% drop in price over the past 4 years. That obviously is huge, hugely eating into the coal market, and as a result, we're seeing more talk about building natural gas plants rather than coal plants. The coal plants that exist are, of course, benefiting from new technologies, improved scrubbing technologies, so that even dirtier grades of coal can be used in them. But to counterbalance that, the existing coal-fired plant, about 40% of them are going to require upgrades to comply with new EPA regulations with regards to pollutants. And there are a lot of other signs that coal is in some deep, serious structural problems in the United States specifically, and I think that's going to have knock-on effects in coal markets around the world, because obviously I think what we're seeing right now is something of an abandonment of coal in favor of even existing energies like natural gas, let alone what we could be seeing coming online in the future.
What about wind and solar?
Wind and solar, well, again, these are basically subsidized to the point where they become viable, but without the subsidies, I don't think they've ever proven that they're going to be a viable alternative. Certainly with something like solar, it doesn't necessarily hurt for people to have solar panels or to feed back into the energy grid and to earn some money that way. But when it comes to wind power, it has been a boondoggle in pretty much every country it's ever been attempted in. So I don't put any big hope in that as a transformative or disruptive technology that's going to have a significant effect on the more established energy sources. But I stand to be proven wrong on that account.
And of course, we have a French scientist who has developed a car that runs on compressed air. He says his only problem is distributing the tanks that you need to run the car, which run on an incredible pressure, something like 4,300 pounds per square inch. But he said you can go over 100 miles at 50 miles an hour on compressed air. How's that for an energy source?
Well, that would be incredible, and I guess I'll believe it when it's on the market, in the sense that I'm sure there are technological advances like that, and we've seen indications of that before, water-powered cars and the like, but for some reason those tend to never get on the market, and it always tends to be oil and gas that continues to dominate the energy sphere. One might even speculate about potential suppression of new energies by big oil and gas and other vested energy interests, who of course stand to have enormous economic benefits from the basic monopoly that they have over the energy supply. And I tend to be in that crowd as well. I think a lot of these incredibly disruptive technologies don't end up getting to market. One reason or another, basically because it doesn't serve the interests of people who benefit off of that energy monopoly.
And I'm wondering, too, what about the impact of 3D printing on China, which is a huge source of manufacturing?
Well, that's interesting. In fact, I saw a 3D printed building that was going up in China recently. They're basically constructing houses out of concrete that are actually laid down in a 3D additive technology process. It's so, in some ways, China is in fact embracing this technology, but I think the general point that I think you're trying to make there is well taken, that 3D printing, to the extent that it does advance and can create more complex and more industrial use products than has been available in the past, does represent a threat to the traditional labor markets and the need for having people on assembly lines. Now, I think ultimately that is a good thing for the economy, in the same way that it's a good thing that we don't need horse and buggies and blacksmiths and things in this current day and age. But that doesn't mean that the horse and buggy manufacturers and the blacksmiths suffered at the time of the changeover of the economy back in the early 20th or late 19th century, early 20th century. And that means that there are a lot of manual laborers on factory assembly lines who are going to suffer in this changeover as well. I think ultimately, as I say, the overall economy is going to benefit from these types of technologies, but it is a question of the transition and what happens to the workers in the meantime. And certainly I think China is going to start feeling the pinch that the American manufacturing base felt 20, 30 years ago as the offshoring process began and the American decline started to set in. I think China is going to feel that in the future, not necessarily from a cheaper, lower cost labor pool than what they provide, but because of technology itself, which could make that type of labor pool unnecessary altogether.
Well, we're hearing how drones and robots are going to replace all the delivery jobs, the taxi jobs, truck drivers. Australia says they could lose 2 to 3 million positions for people to work because of robots within the next 5 to 20 years.
It's certainly possible given the types of technologies we see coming online and the ways they're being used. In fact, I would be more surprised if that ultimately didn't end up being the case. And I think we're being prepped for this possibility in a number of ways in terms of just the public consciousness that's involved in this type of fundamental changeover in manufacturing in terms of the economy itself. I mean, this is a pretty huge change that we're about to go through. So we start to see more and more of these types of stories about, for example, we had that the Future of Humanity Institute, I believe it's called, coming out with its letter that's co-signed by people like Stephen Hawking and the Tesla CEO, I forget his name off the top of my head. But,
Elon Musk.
Like that. Yes, Elon Musk. And people like that signed a letter talking about autonomous robots and their potential use as weapons on the battlefield and how we must prevent this. And we start to see more and more of this seeping into the public consciousness. And I think that's because we really are going to see this technology taking over in a number of different ways. If not necessarily taking over the earth, at least taking over the economy and the sort of physical manual labor of the economy. So I think people would be best served, certainly young people who are looking to start out would be best served to keep that in mind when they are looking for how they can fit themselves into the economy, because there are going to be a lot of jobs that we're going to see disappearing in the next decade or two for sure.
We're speaking to James Corbett, publisher of the Corbett Report. He's based in Japan. Is the crash of the economy in Greece and now Puerto Rico defaulting, is this something we're going to see more and more often?
I think so, and I think this is related in some key respects to what's happening globally. In times where there is global growth that is based on actual economic productivity, a lot of the structural problems in countries like Greece or Puerto Rico or Spain or Italy or Portugal or places like that tend to be masked by the overall economic growth that's taking place around them, and rising tide floats all boats. So we don't tend to notice when there's these types of structural problems. But then when we see the slowdown in economic activity, we suddenly see, who's actually wearing swimming trunks and who isn't. And unfortunately, Puerto Rico is the latest case where we're seeing the real deep structural problems of that country's economy, which again was masked by the growth in the beginning part of last decade, but has really come to the surface in the last few years, where we've seen the percentage of public sector debt as a percentage of GNP now upwards of 100. So we have 100% of the debt is equivalent to GNP, which is not quite at Japanese levels, but it's still quite high and obviously too high. So we've seen $72 billion of public sector debt racked up in Puerto Rico. And they've just recently defaulted on a municipal bond payment, the largest municipal default that has happened in the United States ever. So that's a pretty significant thing. And again, I think it is related to what's happening generally in the global economy right now. And that's being reflected in the fact that Puerto Rico is essentially a stagnating economy, and also there's a brain drain that goes on as the more upwardly mobile elements of the economy tend to leave for the U.S. mainland. So it's been a country in decline for a long time, but as I say, that was masked for a long time, but now we're seeing some of those chickens come home to roost. And basically the Puerto Rican government's only solution to this is to say, well, we're never going to be able to repay this, so we need a haircut. And they're going to apparently continue trying to continue with all of the various things that they do in their economy, and they've been spending, for example, greater and greater amounts of their of money on the education system and getting less and less results. Even though there are a lot fewer students in the system than there was even a decade ago, they're still getting pretty poor results when it comes to their education. So there's a lot of deep structural problems in places like Puerto Rico, and as I say, those structural problems can't hide in a global environment where we are seeing this economic slowdown.
Now, of course, everybody has their eyes not just on Greece, but Spain, Italy, Portugal, even Finland. They're all countries that are on the brink. Are they going to keep pressuring Greece to come up with new economic deals just to keep the others in the European fold?
I think that's a big part of what these negotiations are really about. It shouldn't just be seen as a negotiation between the Troika, or whatever they're calling themselves, in Greece. It has to be seen in the context of basically the ECB and the IMF and these organizations trying to send a message to those other periphery countries that basically we're not going to give Greece some huge debt haircut because then you're going to be demanding it from us. So I think that's a huge part of these negotiations and deliberations. But then at the same time, obviously, I think that the ECB stands to benefit much more from keeping Greece in the Eurozone and basically taking over more and more of the running of its economy. And I think that's going to be the other dangerous precedent that's set here. Ultimately, the ECB is going to be able to say, look, we can't really administer this regional currency if we don't have control over the monetary policy of these countries. So we're going to have to start taking that over. And I think that's going to be the next shoe to drop, not necessarily right away and not necessarily as a direct result of this Greek crisis, but I think that's ultimately where this is heading.
Something that nobody's really talking about right now, but has a huge economic impact around the globe, the sanctions against Russia because of their actions in Ukraine. In Canada and the U.S., pork producers, Russia was a major market. Now they've lost that. That cost them billions. In the Netherlands, dairy farmers have lost their major export market, Russia. Is the idea of sanctions old-fashioned and just not really workable?
Well, there's an interesting post up right now by Sharmin Narwani, who is a Middle East geopolitics commentator who was at the Iranian nuclear negotiations, and she was making the point that all of this talk about how the strict U.S. and Euro sanctions on Iran were biting and were going to ultimately cause Iran to crumble, and all of this was in fact the exact opposite of reality. Although the sanctions obviously did hurt the Iranian economy, ultimately it wasn't Iran crawling back to the table so much as the United States desperately trying to hammer out an agreement for various reasons of its own. So I think that the effectiveness of some of these sanctions has to be called into effect. And again, like in Russia, I think the sanctions have certainly had their effect, and it has shrunk the economy, but probably not as much as a lot of people were thinking. And inflation certainly has gone up, but again, probably not to the extent that a lot of people would have expected. It's not at all clear that these sanctions really ultimately have the effect that they're attempting to have. And certainly, in terms of changing anyone's negotiating positions or bringing anyone to the table, they don't seem to have a lot of effect that way. In the exact same way that the sanctions that were imposed on Iraq didn't ultimately do anything except starve 500,000 children to death in the 1990s. So, again, these sanctions tend to affect people on the lowest rung of the economic ladder of these countries, but do nothing to affect the governments themselves.
Right, I was going to say, I'm sure Putin gets caviar with dinner every time he wants it.
Yes, and then as for everyone else, let them eat cake. And unfortunately, that's pretty much a universal phenomenon, and we see the politicians acting that way all around the world every day.
Is September shaping up to be one of the most volatile months in trading?
It certainly has that potential. And this should not really be a surprise just in terms of general market activity. I think we obviously always see a bit of a sell in May and go away, come back again after Labor Day is kind of the refrain that a lot of traders use. So we don't see a lot of volatility, or we don't see a lot of trading, I should say, in the markets in the summer months. And then obviously when everyone returns in September, October, we start to see some pretty big changes coming. So that just from a sort of market cycle, we would expect some volatility in September. But added on top of that, we have, of course, the next Federal Open Market Committee meeting, September 16th, 17th, and then at the press conference on the 17th, they are going to announce whether or not they're hiking rates. And if we do see that rate hike announcement, I think we're going to see some significant market activity surrounding that. In fact, even if we don't see the rate hike, even just a hint of whether or not it's coming soon or later or what have you, again, I think there's going to be a significant amount of activity surrounding that. And then right on the heels of that, we have the next crisis, quote unquote, of funding for the U.S. government, because basically they're going to start running out of money to fund the U.S. government once again. So there's going to be another negotiation with a potential government shutdown coming if there is no funding agreement reached by, I believe, September 30th, or was it October 31st? At any rate, on one of those deadlines, the U.S. government is going to be out of money, and they're going to need stopgap funding until the budget is passed. So we could see another government shutdown and all of that, which could obviously have a huge effect on economic or market activity. And also, in the last government shutdown crisis, we saw Moody's talking about at least putting the country's AAA credit rating on negative watch. So these can have, even if it is all just political grandstanding, it still can have a significant potential consequence. And I think we have to look at that. And then, of course, we have an IMF World Bank annual meeting followed by a G20 summit. So there's a lot of potentials for some large market volatility and some big changes in the market this fall. And a lot of people are pointing to that and wondering if this is when the chickens start coming home to roost in terms of the QE madness that's gone on the last several years.
Bill C-51, so controversial in Canada. Have you guys overseas thought about it and what role it might play in the markets and Canadian financials?
It doesn't get a lot of play in the news media here in Japan, but I have certainly been watching it from Japan and looking at the conversation that's taking place in Canada right now. I can't say that it's particularly surprising that legislation of this sort was passed. I think it's more surprising that it took this long for the Harper government to do it, but at any rate, here it is, and we have yet to see how it is going to be applied and what rules are going to be enforced and how they're going to be enforced, and how some of this vague language about supporting terrorist activity is going to be ultimately used. So I think there's a lot of question marks about the extent that this is going to affect the Canadian populace, but certainly it has the potential for being a huge damper on free speech in Canada. In terms of how this is going to affect markets, well, I think the most direct effect that I can think of off the top of my head is the fact that this is going to affect the no-fly list, and is potentially going to put a lot more people on that, which of course can have effects not only on business people who are affected by that directly, but also just on the airlines, generally speaking. In terms of other market effects of this legislation, I'm not sure that there's any direct mechanism for that type of market effect, but it will be interesting again to see how this bill is actually applied. I wouldn't expect any controversial prosecutions or anything during the election period, though. I think we're really going to see how this ultimately pans out after the election.
Well, we found out the Foreign Affairs Department was under orders from the Prime Minister's office to release 3 stories a week about terrorism, whether there was any going on or not.
Again, not particularly surprising. Again, the only surprise that I have is that it took this long for this to reach this point, especially because you would expect them to have struck while the iron was hotter back in the early part of last decade. But then again, with the rise of the ISIS crisis and all of this, I guess it is just part of the zeitgeist right now. But yes, I mean, manipulation of the news cycle by governments for their own advantage is nothing new. And of course, we remember Homeland Security Chief, I believe it was Tom Ridge. No, I believe I'm getting that confused. But one of the old Homeland Security chiefs coming out years later to admit that the raising of the alert system in the United States, the color-coded alert system, was done for political purposes and to help re-elect George Bush back in 2004. So we can expect, I'm sure, a lot of the same tricks being applied by the Harper government right now.
Well, right now, we keep hearing about hacking attacks on government websites in the RCMP by some kind of watchdog terrorist internet something group where they've got a guy with a mask and a logo and everything. And to me, it just seems to be a Class C movie plot that it seems to me pretty obvious that this is, how many terrorists really go around doing that?
It's a good question, and it's not a question that we could possibly answer. When it comes to these types of cybersecurity threats, there is no way that we can, as the outside public, can look outside and look into that problem and have any understanding or idea of where these attacks are coming from or how, because we don't have direct access to these servers and the server logs. So we basically have to take the pronouncements that are coming down from on high about these things. And of course, it always turns out that it's blamed on political enemies or on shadowy terrorist organizations, when in fact, interestingly, the JP Morgan hack from last year was recently traced back to some people in Florida and Israel. And interestingly enough, we've seen the talk of those arrests that just came a week or two ago has basically come through the news cycle and disappeared. Whereas we can imagine if it was ultimately traced back to Russia, as apparently the chief of the internal security at JP Morgan wanted to do, and he used to be the head of the cyber comm office at the U.S. Air Force, but now he's working for JP Morgan. Apparently he was trying to blame it on the Russians, but a lot of the staff within the JP Morgan security division were basically giving a lot of kickback, saying this is garbage, this isn't true. And now it's turned out that there's been some arrests made of some Israelis regarding this hack, and it's disappeared from the news headlines. So we always see, I think, the propagandistic value of these cybersecurity threats more so than we see any actual exposition of who's really behind these hacks.
And speaking about economies going into elections, Canada, I think, technically is in recession, although the government refuses to use the R word. Is Canada in recession, and is the U.S. far behind?
Canada is officially, well, no, as you say, they won't use the word, but it is in recession right now. And the U.S., I absolutely, I mean, when and if the Fed raises rates, I think there's no question that recession and potentially much worse is coming. It's only a question of how long that it takes to catch up with the market. And a lot of people are pointing back to 1937 when the Fed started tightening at that time, because they saw some indications of some positive economic activity coming out of the Depression, and ultimately caused a recrash of the economy. And it took a couple of rate hikes to get there, but it did happen. So I think people are looking to that as really what's going to be shaping the U.S. markets. But yes, I think there's no doubt that Canada is in recession right now, and things are pretty bleak for a lot of people. And it's just a question of what pops first and in what way, but I think the Canadian housing market remains a juicy target for that.
How much of a bubble is there in Canadian real estate?
It depends who you ask, and it depends in what way you ask it. But for people who look at the charts, obviously the Lehman crisis caused the collapse of the subprime housing market in the U.S. and caused housing prices to go down generally. That did not take place in Canada, and Canada has been rising in terms of housing markets and also in terms of mortgage debt ever since. I think that ultimately they're going to have to pay the piper in the same way that the U.S. did several years ago. It's just a question of when. So I think there is no doubt there is a bubble of sorts. It's just a question of when it pops, how it pops, and how badly it'll pop.
James, how can people subscribe to your newsletter?
The best way to get my work is through CorbettReport.com. That's CORBETT report.com. All of my work is there freely available for people to download. I hope they use it as a resource. If they're interested in my weekly editorial for the International Forecaster, you can go to theinternationalforecaster.com.
My guest has been James Corbett, publisher of the Corbett Report. Well, that wraps up the show for this week. Thanks to our guests, Ross Clark and James Corbett, and thank you for listening. Comments or questions for This Week in Money can be emailed to info@howstreet.com. I'm Jim Goddard. We're back next week with more This Week in Money.
This Week in Money is a production of How Street Media Incorporated.